Hello, and if you're looking to create an investment grade portfolio with the best possible risk return profile, welcome. For a refresher on the basics of yield, call options, and credit risk, have a look at our blogs linked in the description of this video. And for a video presentation of the basics, check out Save with Corporate Bonds. For videos on reviewing fundamentals and technicals specific to corporate bonds, watch our Upgrade Your Bond Fund and Beat Your High Yield Bond Fund. They're all linked in the description. Managing your bond portfolio means you take control of a key aspect of your financial life, which is your savings. A savings instrument for our purposes means any corporate bond that you intend to hold until its maturity in less than 5 years and is currently rated investment grade by Moody's, S&P, or both, with no non-investment grade rating. To make sure we're focused on bonds that we could buy when we want and that we're not getting a raw deal, we'll apply the standard Good-Fill bond rules. 1. No bonds with less than $100 million outstanding. And 2, if a bond is between 1 and 500 million, it must have traded more than 10 times per day on average over the past 2 months. We may miss a few good trades this way, but we'll miss many more bad ones. Now let's talk about 2 key concepts for managing your own investment grade portfolio: diversification and allocation across sectors and industries. There is one and only one benefit to diversification across issuers, and that's to reduce the damage from any single default. Like most benefits, there are costs, and the first one is that with every bond you add, the likelihood that your portfolio suffers a default goes up. The second cost is that with every additional bond, the yield you earn from coupons and principal appreciation goes down. If you didn't diversify at all, you would just own the highest yielding bond that meets your criteria. Which side of the scale tips the cost-benefit balance is different in every portfolio, so let's look at our second key concept: sector and industry allocation based on a company's lines of business. In the financial sector, for instance, there are multiple industries such as life insurance, commercial banking, and business development companies. The most important allocation decisions are setting the maximums for particular sectors and industries in your portfolio. The cost-benefit comparison is the same for allocation as it is for issuer diversification. Reduce your exposure to trouble in any one sector or industry at the price of a lower yield and a greater likelihood that you could encounter some trouble. Now let's take a look at a model portfolio which has 3 BDCs, 3 firms from other financial industries, and 6 non-financial companies. This is all in the Good-Fill app for the iPhone and iPad, available in the Apple App Store. If you already have a broker or investment advisor, they should offer something comparable. Our portfolio's yield is 6.64%, averaging 2% above each bond's comparable U.S. Treasury, and the average maturity is 3.4 years. The current market value is $23,208, on which you'd earn an additional $5,276 in interest and principal appreciation to maturity. You can see how the yield cash flows as well as redemptions are distributed over time. Why this combination of industries? The reason is that if we took the 6 highest yielding bonds in the financial sector, they would all be BDCs. So what exactly are BDCs? A business development company raises money by issuing equity and debt, including bonds, to investors. The BDC then invests in the debt and equity of small and medium-sized companies, mostly backed by large financial sponsors. From a BDC bond investor's perspective, the most significant fact is that the company can only borrow a maximum of 2 times its equity, meaning bondholders lose no money until 1/3 of the BDC's assets are wiped out. At the end of its last fiscal quarter, Silicon Valley Bank had borrowed 12 times the value of its equity, meaning a mere 8% loss of its asset value pushed the company under, and that balance sheet profile persists in many banks today. So what do BDCs own? Let's take a look at the issuer of our highest yielding bond in our model portfolio, Prospect Capital. Like most BDCs, Prospect discloses their portfolio companies and the form of investment, secured debt, unsecured, or equity. 74% of Prospect's holdings are secured debt, including one position in BPCE Northstar US Holdco, for example, which was acquired by Desert Holdings, owned by Mitt Romney's alma mater, Bain Capital. While every BDC position is different, all BDCs offer unsecured creditors 4 times more loss protection than banks and are required by rating agencies to diversify across issuers as well as sectors. They do not take market risk, which is what sunk Silicon Valley Bank. Now let's take a look at how our model portfolio performs under stress. Let's suppose Prospect Capital defaults 1 year from today and recovers 50% of its value. Remember, all 5 senior unsecured Silicon Valley Bank bonds still trade at over 60% today. A Prospect default would drop the portfolio yield from 6.64 to 5.05%. What are the chances on a historical basis that any of our portfolio bonds defaults? Our dozen bonds are at the lower end of investment grade, so let's look at triple Bs, which averaged 2.5 defaults out of 10,000 over the last 11 years. Silicon Valley Bank was the only triple B issuer to default last year, and no triple Bs defaulted at all in 8 out of the last 11 years. Even if a bond was downgraded to double B, only 2 out of every 1,000 defaulted on average each year since 2013, and in 2019, the default rate of double Bs was lower than triple Bs. Based on that, there's a 1% chance that our portfolio yield drops to 5.05%, and that probability goes up to 1.5% if we assume the 2% historical average rate of downgrades from triple B to double B. Even then, 5.05% is still 60 basis points higher than the 3-year Treasury bond. That's the power of strategic diversification. Our portfolio holds up well under a lot of stress, but every one of these bonds made this list for a reason. They're all high-yielding investment-grade names who also all file public financial statements to the SEC every quarter, so their challenges are no secret. PSEC, NMFC, and BBDC, for instance, are leveraged over 10 times, putting them above the 90th percentile across all bond issuers, including high yield. They also all have tangible book values above $1 billion, positive net income, and positive free cash flow, which puts them ahead of many other investment-grade issuers. Why so much focus on leverage? In the world of corporate bond investing, leverage is without a doubt the single most referenced fundamental metric. It's the ratio of total debt to EBITDA, which is a broad measure of earnings, and 2/3 of all bonds are from issuers who are leveraged 5 times or less, while 93% of issuers are leveraged 10 times or less. Whenever you're considering a bond, check the issuer's leverage, and you can refer to this chart in the Feed tab of the Goodfill app to see how it compares to the full universe of issuers. The one catch with leverage is that it's traditionally not applied to banks and insurance companies who account for over 1/3 of outstanding bonds. The rationale is that there are better ways to measure their credit quality, which all happen to be extremely complicated. If the leverage calculation was applied to banks exactly as it is to other industries, the results would be well into the double digits, indicating a high degree of risk, which, as we've seen, is probably not unjustified. Let's go back to our key factors, look at our 4 issues with leverage below 5 times, and see what they did to end up on our list of high-yielding investment-grade bonds. Leggett & Platt has negative tangible book value and lost money over the last year, while Concentrix has significantly negative book value due to some aggressive acquisitions. Targa didn't have any negative fundamentals, but the oil and gas industry is out of favor with many investors, while AEL gets penalized for being a small insurance company owned by a financial sponsor. All of our bonds have survival probabilities above 85%, which means that although they are high yielding, the market believes they're more likely to redeem in full than 28% of all bonds. Refer to the blog below for a refresher on how survival probabilities are calculated, including the difference between a 6-month and a 26-year Walgreens bond, both of which are rated BBB- Ba2. These issuers also all have positive free cash flow, which goes a long way in the world of credit investing. If you ever see a bond survival probability and wonder how that ranks against the field, just check this chart in the Good Fill Feed tab and you'll see the distribution across all bonds. The average yield of bonds with survival probabilities above 98% is 5.36, while the average yield of bonds with survival probabilities above 50% is only 5.61%, and that includes non-investment grade bonds. This is why the yield of bond index funds is so low. They own every single bond regardless of the yield. Does that 1,000th position really give you any benefit from diversification? It does lower your yield and expose you to yet another default. To summarize what we've covered so far, 1. When you build your portfolio, choose bonds with sufficient liquidity and outstanding amounts. 2. Apply your maximum maturity. We recommend 5 years. 3. Apply any sector and industry maximums, including to BDCs. 4. Review the fundamentals of each issuer and replace any that don't meet your criteria. 5. Stress test your portfolio to determine the impact of a default. And lastly, evaluate your risk based on historical default rates and on a forward-looking basis with survival probabilities. The process for estimating the historical likelihood of one bond in a BBB portfolio defaulting is shown here based on our earlier S&P figures. Of course, you're always looking for the highest yielding bonds that meet your criteria, but if you find a couple from the same issuer with significantly different maturities and only a few basis points difference in yield, opt for the shorter one to boost your survival probability and improve your risk-return profile. If there's one lesson we learned from the financial crisis, it's that we need to use market-based risk indicators in addition to historical ones. Now that you know how to maximize your return and quantify your risk, check model portfolios available from your favorite broker, RIA, and of course, Good Fill. We post 8 model portfolios, including the one we reviewed earlier, with yields from 6.2 to 11% and average maturities from 1.25 to 3.5 years. Stress test for any default date and recovery, substitute bonds as you like, and easily export your portfolio for immediate execution in an interactive broker's account. If you use an investment advisor, send over your favorite portfolio and see what they think. If you are an RIA, we'll add your portfolios to be viewed by your clients with our full suite of real-time analytics. Thanks very much for sticking with us. Give us a like, subscribe to our channel, and whoever you trade with, insist on good fills.